Hi everybody, this is Eddie Gabor, Managing Partner of Key Advisors Group, and in today's video I want to talk about how investors can potentially avoid making emotional decisions with their portfolio. It is proven time and time again, you look at any type of research, and when you look at the psychology behind investing, it happens so often, no matter how seasoned the investor is, and that's probably the one thing that has blown my mind over the last 20 plus years is I've had the privilege of working with a lot of very successful people. But at the end of the day, they're still human beings. And that's why I'm so intrigued with understanding the psychology behind what goes through the mind of an investor, because I think the more you understand the psychology behind investing, the more you can become a better investor. And if I had to point to one mistake that people make time and time and time again, no matter what, is they make a decision based on emotions and not fundamentals when it comes to their portfolio, okay? You can almost find anything negative to point to on any given day of the week as to why you should sell the stock market. You could also look to something almost every single day as to why you should buy the stock market. And there are some analysts that are always bullish no matter what the fundamentals say, and then there's some analysts that are bearish no matter what all the fundamentals say. And I think it's important to see their points of views because you can point something and get something from each one of them. I prefer someone that goes both ways in regards to bullish or bearish based on fundamentals. And that's how I like to look at myself, is I'm bullish when I think fundamentals are extremely bullish, and I become bearish when I think the fundamentals are really breaking down and is reason for caution as an investor. But regardless of what our opinion is, we never, ever want to make a decision based on what the headline news is, okay? Because by the time it's headlines, think about it. It's already priced into the market. And when you look at any time there's been any type of major market crash, I don't care if it's the tech bubble burst of 2000, the Great Recession of 08, 09, you can look at the drop that we had during the pandemic, which was a drastic drop. You can look at the drawdowns in the 80s. You can look at the last 40 plus years. Almost all the time, retail investors are selling after there's been a huge drawdown. There's a saying I like to use to clients, and you've probably heard it before, and that is put your blinders on, okay? Putting your blinders on simply means is ignore the noise, okay? That noise has absolutely nothing to do with your personal goals and your personal objectives. Whether you're managing your money yourself or you're working with an investment advisor like myself, your portfolio should really be driven by your specific goals, your objectives, and your risk tolerance, okay? So one day's news should not change your goals and objectives as an investor. You need to make sure you have a proper risk management strategy with your team. And I would ask them, if you've never asked this before, is what is my risk management strategy? How do I de-risk when fundamentals break down? Not because there's a headline of someone going out of business or there's some headline on what the Fed might or might not do, because many times those are 1 or 2 day events that last 1 week or 2 weeks, and it shouldn't have an impact on your long-term investment objectives. So as an investor, the more you educate yourself on the psychology behind investors and get yourself to not be so emotional and tied to the day-to-day media that is just shoved down our throat. I mean, Twitter, 24 hours a day, you can find information on Twitter that, again, can scare the hell out of you and make you want to sell or make an emotional decision. I think you have to take a step back and ask yourself, is that headline going to change anything in regards to what my goals and objectives are and to what my risk tolerance is? I mean, if you're 15 years away from retirement, do you really care about an event that might last a month or 2 or 6 months? I know for myself personally, I don't. I'm not going to make a huge facelift to my portfolio. Now, if it looks like we could potentially see a pretty big drawdown because of certain fundamental breakdowns based on the type of risk management strategy you have, and you want to de-risk a part of your portfolio, I'm fine with that because that's tied to your risk management strategy based on fundamentals and based on a process, not based on what's on the headline of the news media that particular day. Remember, there's a saying that says bad news sells, and the reason why that saying is so true is when there is something negative out there, the news outlets reports it nonstop until it just makes you want to vomit. And When you hear negativity time and time and time again, it can play mind tricks on you and force you to pivot and do things you normally wouldn't do. I'd rather you just turn the internet off and the TV off during time periods like that and just focus on your life and things that are important to you, because ultimately my guess will be, if you have a sound portfolio, that negativity in the media may cause your portfolio to go down for a few months, but ultimately not change the long-term trajectory of what you're trying to do. So in my opinion, someone needs to de-risk when the process that they use, that the signals are pointing to that. And if you don't have a process, I challenge you to get one. Look, there are lots of firms out there today that if you're managing your own money, you can subscribe to them, find one that you like and you can enjoy. A lot of them will give you a free subscription for a few days, 30 days, and really try to put together a process. Because if you have a process, then it doesn't matter what the media says. You know, we laugh in our office when there's some big major headline that is causing markets to drop, because when our process is telling us that this media outlet that's reporting this negativity is absolutely meaningless to the underall fundamentals of the market, we know that people are acting on that, but our process is telling us we don't have to do a thing. And when you have that process, it is extremely comforting to know that you have a sound strategy that the media cannot affect unless you act on it. So the number one thing that I've seen investors do that is a big mistake is they act on emotions based on headlines. And in my opinion, people that do that is one of two reasons. A, they're carrying too much risk and the volatility they can't stomach. And B, they don't have a risk management process that helps them make a decision. If you make a decision because you say, I have a gut feeling, then that tells me you don't have a process. Because when you invest in the markets, it shouldn't be off of a gut feeling. It should be off of something that you have in place that tells you whether it's a buy or a sell. And in my humble opinion, if you don't have that, you are missing a key component of being a successful long-term investor. You might get lucky once or twice on a gut feeling. But in my opinion, that's like going to the casino. Build a process, ignore the noise, and that will eliminate you, in my opinion, or at least increase the chances of you not making an emotional decision that you will regret that could hurt you. I can't tell you how many times I've heard people say, boy, I wish I didn't sell at that time, but my neighbor was telling me to sell. The world looked like it was coming to an end. The media was telling us we were going into a depression, and I missed the snapback of the rally. If you have a process and you understand it and you're disciplined and you stick to it, hopefully that won't happen to you. So that's my message today. If you have any questions, please shoot me a message and I'll be able to address it and be happy to address it in my next video. Thank you and have a great day.